Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about USA Rare Earth Inc. Annual Report. USA Rare Earth Inc. offers a range of businesses and services related to rare earth elements and critical minerals. The company's primary focus is on mining, processing, and supplying these essential materials in the United States. At its core, USA Rare Earth Inc. provides exploration services for various rare earth elements such as neodymium, dysprosium, terbium, yttrium, gallium, beryllium, and lithium. The company also holds significant interests in the Round Top Mountain project, located near Sierra Blanca, Texas. In addition to its mining and exploration activities, USA Rare Earth Inc. is involved in processing and supplying these critical minerals. This comprehensive approach enables the company to cater to a wide range of industries that rely on rare earth elements for their operations. Overall, USA Rare Earth Inc.'s services include mining of rare earth elements, exploration for various critical minerals, processing of rare earth elements, supplying of these essential materials in the United States. By providing these services, USA Rare Earth Inc. plays a crucial role in meeting the growing demand for rare earth elements and other critical minerals in the country. USA Rare Earth Inc. market capitalization of $3 billion is significantly larger than the average industry peer of roughly $1 billion. This shows that USA Rare Earth Inc. holds a significant advantage in their industry. USA Rare Earth Inc. trades at a higher price-to-book ratio of 4.59 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The balance sheet appears very conservative, with liabilities representing only 29% of total assets. While this indicates low financial risk, investors should examine the composition and quality of the company assets to determine whether they justify the current valuation. Average liabilities have increased consistently as the company expands. Importantly, both assets and shareholder equity have grown at least 20% faster than liabilities, indicating that the business is expanding substantially and generating value after covering its obligations. Shareholder equity has grown consistently, but operating income growth is weak or inconsistent. Equity expansion may be driven by financing activities rather than core business profitability. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The primary drivers of revenue growth can be identified through a review of various sections within the extracted summaries. One key factor contributing to revenue growth is the presence of intangible assets, including customer relationships, supplier relationships, trade name, and know-how. These assets have been instrumental in driving revenue upwards. Another significant driver of revenue growth is revenue synergies resulting from combining operations. This synergy has enabled companies to tap into new markets and expand their customer base, leading to increased revenue. Additionally, obligations arising from the IORM, accretion, and foreign currency translation have also contributed to revenue growth. Furthermore, cash received, excluding amounts recognized as revenue during the year, has seen an increase of $23. This suggests that companies are generating more cash through various means, which in turn is contributing to their revenue growth. The amortization of identifiable intangible assets and net operating loss of foreign entities have also driven revenue growth. In summary, the primary drivers of revenue growth include intangible assets, revenue synergies, obligations arising from IORM, accretion and foreign currency translation, cash received, and amortization of identifiable intangible assets. The financial report of the company reveals a concerning trend regarding its operating cash flow. The net loss from operating activities has increased significantly, amounting to $36 million in the current year compared to the previous year. This substantial increase indicates that the company is struggling to generate positive cash flow from its core operations. Furthermore, the absence of an explicit statement on operating cash flow and a net income loss of -$304,517 suggests that the company's financial situation is precarious. The presence of significant liabilities, including derivative liability, earn-out liabilities, and warrant liabilities, totaling $128 million, also points to a potential negative operating cash flow. These indicators collectively suggest that the company is not generating positive operating cash flow, which could have severe implications for its long-term sustainability and growth prospects. The company's debt level and interest expenses have undergone notable changes over the past year. A significant increase in total liabilities is evident, with a 1,137% rise from $176,683 in 2024 to $352,366 in 2025. This substantial growth in debt is reflected in the decrease of total notes payable, which dropped by $1,018,000 from $1,849,000 in 2024 to $831,000 in 2025. However, despite the increased debt level, interest expenses have not been explicitly stated as increasing or decreasing. The interest and dividend income saw a substantial increase of 1771% from $2,900 in 2024 to $8,054 in 2025. Meanwhile, the interest expense and other income, loss, net decreased by $176, minus 56%, from $314 in 2024 to $138 in 2025. Overall, while the company's debt level has increased significantly, its interest expenses remain unclear. Management is outlining a strategic plan to develop a domestic source of critical rare earth elements, REEs, to support its magnet manufacturing operations. This initiative aims to reduce reliance on external suppliers and ensure a stable supply chain. In addition, management has implemented an equity-based compensation plan to incentivize employees and executives. This includes stock options, restricted stock units (RSUs), and performance restricted stock units (PRSUs). The company is also seeking funding and tax incentives from government entities to support its growth and development. The acquisitions and divestitures made by USA Rare Earth Inc. are significant milestones in the company's growth and restructuring. The company has acquired several key assets, including Indian Ocean Rare Earth Metals T. Limited, IORM, for $197.7 million, which included intangible assets such as trade names, customer relationships, supplier relationships, and know-how. Additionally, USA Rare Earth Inc. acquired RTMD, a mineral rights lease in Texas, along with an associated groundwater lease. The company has also made significant divestitures, including the closure of its legacy incentive plan, which resulted in the conversion of outstanding incentive units into approximately 4.55 million shares of common stock. Furthermore, any assets related to the TIF agreement or Governor's Fund agreement have been either divested or exempt from taxation. These acquisitions and divestitures demonstrate USA Rare Earth Inc.'s strategic efforts to optimize its operations and focus on key areas of growth. The company has made significant decisions regarding its financial strategy in recent years. One notable aspect is the payment of dividends to its shareholders. In a move that demonstrates confidence in its financial stability and commitment to shareholder value, the company declared a dividend payout of $1.73 per share. In contrast, the company's approach to share buybacks has been more conservative. Despite fluctuations in common unit holdings, there is no evidence to suggest that the company engaged in any significant share repurchase programs during this period. In fact, the data indicates a slight decrease in common units by 1968, suggesting that the company may have opted for other uses of its capital rather than buying back shares. Concerns about inventory buildup have been identified in the extracted summaries. According to the data, the company's inventory has a value of $15,329 in thousands. Furthermore, it is explicitly stated that there is an issue with inventory buildup, as indicated on page 20. This suggests that the company may be experiencing difficulties in managing its stock levels, which could have implications for its operations and financial performance. That concludes the financial summary for USA Rare Earth Inc. Feel free to comment below, and I will be happy to answer them when possible.